Welcome to Birdsey. In this video, we'll work through exam-style questions, show you what the exam is really testing, and give you clear takeaways to get you ready for exam day. Let's get started.
Let's start with a review of life insurance basics. Which type of life insurance policy provides coverage for a specified period and pays a benefit only if the insured dies during that term? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, endowment policy? The correct answer is A, term life insurance. A term life insurance policy offers coverage for a set period, such as 10 or 20 years, and pays a death benefit only if the insured dies within that time frame. Which of the following life insurance policies guarantees a fixed premium and a guaranteed death benefit for the life of the insured, but does not allow for flexible premium payments? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, variable life insurance? The correct answer is B, whole life insurance. Why this is tricky? Universal life insurance allows flexible premiums, while whole life insurance has fixed premiums and a guaranteed death benefit. The question tests your ability to distinguish between these similar-sounding features. Maria wants a life insurance policy that will accumulate cash value over time and provide lifelong protection. Which type of policy should her agent recommend? Is it A, term life insurance, B, endowment policy, C, whole life insurance, or D, decreasing term insurance? The correct answer is C. Whole life insurance is designed to provide lifelong coverage and builds cash value over time, making it suitable for Maria's needs, as described in the scenario. Which type of life insurance policy allows the policyholder to adjust the death benefit and premium payments within certain limits, but may not guarantee a fixed interest rate on the cash value? B, term life insurance, C, variable life insurance, or D, universal life insurance? The correct answer is D, universal life insurance. Why this is tricky? Universal life insurance offers flexibility in premiums and death benefits, but the cash value interest rate can vary. This question tests your understanding of policy flexibility versus guarantees. A business owner wants a life insurance policy that will provide a decreasing amount of coverage over time to match a declining loan balance. Which type of policy is most appropriate? Is it A, whole life insurance, B, decreasing term insurance, C, universal life insurance, or D, endowment policy? The correct answer is B, decreasing term insurance. Decreasing term insurance is designed to provide a death benefit that decreases over time, making it ideal for covering debts like a declining loan balance.
How'd you do on the first 5 questions? Go ahead and subscribe to Birdsey now and turn your progress into exam day confidence. Ready to jump back in? Let's go.
Policy provisions and clauses definitions. What is the primary purpose of the incontestability clause in a life insurance policy? Is it A, to limit the insurer's ability to contest the validity of the policy after a set time period? B, to guarantee the policy's cash value will increase every year? C, to allow the insurer to change premiums at any time?
Or D, to require the policyholder to provide annual proof of insurability?
The correct answer is A, to limit the insurer's ability to contest the validity of the policy after a set time period. The incontestability clause prevents the insurer from voiding the policy after a certain period, usually 2 years, except for cases of fraud. This protects the policyholder from having their claim denied due to minor misstatements after the period expires. Which of the following statements about the suicide clause in life insurance policies is not correct? Is it A, the suicide clause limits the insurer's liability if the insured dies by suicide within a certain period? B, if the insured dies by suicide after the exclusion period, the policy will pay the death benefit? C, the suicide clause means suicide is never covered under any circumstances? Or D, the suicide clause is intended to prevent individuals from purchasing insurance with the intent to commit suicide soon after? The correct answer is C. The suicide clause means suicide is never covered under any circumstances. Why this is tricky? A suicide clause typically excludes coverage for suicide within a specified period, but after that period, suicide is covered. The incorrect statement is the one that claims suicide is never covered, which is misleading. Maria purchases a life insurance policy and forgets to disclose a minor surgery she had years ago. 3 years later, she dies and her beneficiary files a claim. How does the Incontestability clause affect this situation? Is it A, the insurer will automatically deny the claim due to the omission? B, the insurer cannot contest the claim based on the omission after the contestability period has passed? C, the beneficiary must prove the surgery was not relevant to the policy? Or D, the insurer will refund premiums but not pay the death benefit? The correct answer is B. The insurer cannot contest the claim based on the omission after the contestability period has passed. The Incontestability clause prevents the insurer from denying the claim for misstatements after the policy has been in force for the specified period, unless fraud is involved. Since 3 years have passed, the claim is likely paid. Which provision allows a policyholder to reinstate a lapsed life insurance policy, and what is typically required? Is it A, grace period provision? B, Incontestability clause? C, suicide clause? The correct answer is D, reinstatement provision requiring payment of back premiums and proof of insurability. Why this can be tricky? The reinstatement provision allows a lapsed policy to be restored, but only if the policyholder pays back premiums and provides evidence of insurability. Some may confuse this with other provisions or overlook the insurability requirement. After missing a premium payment, John receives a notice from his insurer stating he has a certain number of days to pay before his life insurance policy lapses. What policy provision is being applied in this situation? Is it A, entire contract provision? B, misstatement of age provision? C, grace period provision? Or D, free look provision? The correct answer is C, grace period provision. The grace period provision gives policyholders extra time to pay overdue premiums before the policy lapses. This protects the insured from immediate loss of coverage due to a missed payment.
If you want more than just rapid-fire questions, head over to birdsey.ai. You can take unlimited practice exams and get instant help from your personal AI study partner. It's like having a tutor 24/7. Try it free. You'll find a link in the description.
Beneficiary designations terminology. What is the term for the person or entity who receives the death benefit from a life insurance policy upon the insured's death? Is it A, beneficiary, B, policy owner, C, insurer, or D, agent? The correct answer is A, beneficiary. The beneficiary is the person or entity designated to receive the policy's death benefit. This designation is a fundamental aspect of life insurance and ensures that the proceeds are distributed according to the policyholder's wishes. Which of the following statements about contingent beneficiaries is not correct? Is it A, a contingent beneficiary receives the death benefit only if the primary beneficiary predeceases the insured? B, the policy owner can name more than one contingent beneficiary? C, a contingent beneficiary receives the death benefit before the primary beneficiary? Or D. Contingent beneficiaries have no rights to the policy while the primary beneficiary is alive and able to claim the benefit. The correct answer is C. A contingent beneficiary receives the death benefit before the primary beneficiary. Why this may be tricky. The term contingent beneficiary refers to someone who receives the benefit only if the primary beneficiary cannot. The incorrect statement is the one that confuses the order or conditions under which contingent beneficiaries receive benefits. Maria names her spouse as the primary beneficiary and her sister as the contingent beneficiary on her life insurance policy. If Maria and her spouse both pass away in an accident, who will receive the death benefit? Is it A, the insurance company, B, Maria's sister, C, Maria's estate, or D, Maria's children? The correct answer is B, Maria's sister. If both the insured and the primary beneficiary die, the contingent beneficiary becomes eligible to receive the death benefit. In this scenario, Maria's sister would receive the proceeds from the policy. Premium payment concepts terminology. What is the term for the frequency with which a policyholder is required to pay premiums on a life insurance policy? Is it A, grace period, B, premium payment mode, or D, dividend option? The correct answer is B, premium payment mode. The frequency with which premiums are paid is known as the premium payment mode. Common modes include annual, semi-annual, quarterly, and monthly, and the choice can affect the total cost due to administrative fees. Maria chooses to pay her life insurance premiums every month instead of once a year. What is the term for this payment arrangement?
Is it A,
Annual premium mode, B, single premium payment, C, monthly premium mode, or D, flexible premium option? The correct answer is C, monthly premium mode. Paying premiums every month is called a monthly premium payment mode. Insurers offer various modes, and monthly payments are common for budgeting, though they may cost more overall due to added administrative expenses. Life insurance policy features. Cash value and non-forfeiture options terminology. Which non-forfeiture option allows a policy owner to use the cash value to purchase a reduced amount of paid-up insurance for the remainder of the policy term? Is it A, reduced paid-up insurance, B, extended term insurance, C, automatic premium loan, or D, cash surrender value? The correct answer is A, reduced paid-up insurance. The reduced paid-up insurance option uses the policy's cash value to buy a smaller amount of fully paid-up insurance, which remains in force for the insured's lifetime without further premiums. Which of the following statements about the cash value in a whole life insurance policy is not correct? Is it A, the cash value grows over time as premiums are paid, B, policy owners can borrow against the cash value, C, the cash value always equals the face amount of the policy, or D, the cash value is available if the policy is surrendered? The correct answer is C, the cash value always equals the face amount of the policy. Why this can be tricky. The cash value does not equal the face amount until the policy matures, usually at age 100. Many confuse cash value with the death benefit, but they are not the same during most of the policy's life. Maria owns a whole life policy and decides to stop paying premiums. She wants to keep some coverage without making further payments, so which non-forfeiture option would allow her to do this? Is it A, cash surrender value, B, reduced paid-up insurance, C, extended term insurance, or D, automatic premium loan? The correct answer is B, reduced paid-up insurance. The reduced paid-up insurance option allows Maria to use her policy's cash value to buy a smaller, fully paid-up policy, maintaining some coverage with no further premiums required. If a policy owner selects the extended term insurance non-forfeiture option, which of the following will not occur? Is it A, the original face amount of coverage is maintained temporarily? B, no further premium payments are required? C, the policy's cash value is used to purchase term insurance? Or D, coverage continues for the insured's entire life? The correct answer is D, coverage continues for the insured's entire life. Why this is tricky? Extended term insurance uses the cash value to buy term insurance for the original face amount, but the coverage is temporary and does not continue for the insured's entire life. Policy loans and withdrawals terminology. What is the primary purpose of a policy loan provision in a permanent life insurance policy? Is it A, to increase the death benefit? B, to waive premium payments? C, to allow the policyholder to borrow against the policy's cash value? Or D, to convert the policy to term insurance? The correct answer is C, to allow the policyholder to borrow against the policy's cash value. A policy loan provision allows the policyholder to borrow money from the cash value of their permanent life insurance policy, typically at a specified interest rate, without having to surrender the policy. Maria owns a whole life insurance policy and wants to access some of its cash value without canceling her coverage. What feature allows her to do this? Is it A, accelerated death benefit? B, policy loan? C, extended term option? Or D, automatic premium loan? The correct answer is B, policy loan. A policy loan allows Maria to borrow from her policy's cash value without surrendering the policy, so her coverage remains in force as long as the policy is not lapsed. Dividends and dividend options terminology. Which dividend option allows a life insurance policyholder to use dividends to purchase additional amounts of paid-up insurance? Is it A, cash option? B, premium reduction option? C, paid-up additions option? The correct answer is C, paid-up additions option. The paid-up additions option lets policyholders use dividends to buy extra amounts of permanent insurance, increasing the policy's death benefit and cash value. This is a common choice for those seeking to maximize long-term benefits from their policy. Which of the following statements about life insurance policy dividends is not correct? Is it A, dividends are not guaranteed by the insurer? B, dividends are always considered a return of premium for tax purposes? C, policyholders can use dividends to reduce future premiums? Or D, dividends can be left with the insurer to accumulate interest? The correct answer is B, dividends are always considered a return of premium for tax purposes. Why this can be tricky? All options sound plausible, but only one is false. Dividends are not guaranteed, can be used in several ways, and are not taxable when paid, but they are not considered a return of premium for tax purposes. Riders and additional benefits terminology. Which rider allows a life insurance policyholder to purchase additional coverage at specified intervals without providing evidence of insurability? Is it A, guaranteed insurability rider? B, waiver of premium rider? C, accidental death benefit rider? Or D, accelerated death benefit rider? The correct answer is A, guaranteed insurability rider. The guaranteed insurability rider permits the policyholder to buy more coverage at certain times without a medical exam or proof of health, making it valuable for those anticipating future insurance needs. Which of the following statements about the waiver of premium rider is not correct? Is it A, It waives premium payments if the insured becomes disabled. B. It keeps the policy in force during the period of disability. C. It waives premiums if the insured loses their job for any reason. Or D. It may require proof of continued disability for benefits to continue. The correct answer is C. It waives premiums if the insured loses their job for any reason. Why this can be tricky. The waiver of premium rider only waives premiums if the insured becomes disabled, not if they lose their job or retire. Some may confuse disability with other forms of income loss, but only disability qualifies. Maria has a life insurance policy with an accelerated death benefit rider and is diagnosed with a terminal illness. What feature does this rider provide in her situation? Is it A. It increases her policy's face amount automatically? B. It allows her to receive part of the death benefit while living? C. It waives all future premium payments regardless of health status? Or D. It pays an additional benefit if she dies in an accident? The correct answer is B. It allows her to receive part of the death benefit while living. The accelerated death benefit rider allows Maria to access a portion of her policy's death benefit while still alive, helping cover expenses related to her illness or other needs before death. Health insurance basics. Types of health insurance plans, terminology. Which type of health insurance plan typically requires members to use a network of designated providers for the lowest out-of-pocket costs? Is it A. Indemnity plan? B. Point of service plan? C. Health maintenance organization? Or D. Preferred provider organization? The correct answer is C. Health maintenance organization. Health maintenance organizations, or HMOs, usually require members to use a specific network of providers to receive the lowest costs. Services outside the network are often not covered except in emergencies. Which statement about preferred provider organizations is not accurate? Is it A. PPOs have a network of preferred providers? B. PPOs require referrals to see specialists? C. PPOs allow members to see out-of-network providers at a higher cost? Or D. PPOs generally have higher premiums than HMOs? The correct answer is B. PPOs require referrals to see specialists. Why this can be tricky. PPOs do not require referrals to see specialists, which is a common misconception. They do have a network and offer some out-of-network coverage, but referrals are not needed. All health insurance plans require members to select a primary care physician at enrollment, correct? Is it A. Yes, this is true for every plan? B. Only if the member is under 18 years old? No, some plans like PPOs do not require this. Or D. Only for plans purchased through an employer? The correct answer is C. No, some plans like PPOs do not require this. Why this is tricky. Not all plans require a primary care physician. HMOs do, but PPOs and some other plan types do not, making this statement incorrect. Maria has a point-of-service health insurance plan and wants to see a specialist outside her network without a referral. What is the likely result? Is it A. She will pay the same as in-network rates? B. She will pay higher out-of-pocket costs and may have reduced coverage? C. She will not be covered at all for the visit? Or D. She must switch to an HMO to see the specialist? The correct answer is B. She will pay higher out-of-pocket costs and may have reduced coverage. With a point-of-service plan, seeing an out-of-network specialist without a referral usually results in higher out-of-pocket costs and possibly reduced coverage for those services. John is comparing a high-deductible health plan to a traditional HMO for his family What is a key difference he should consider? Is it A, high deductible plans usually have lower monthly premiums but higher upfront costs? B, HMOs allow unlimited out-of-network care at no extra cost? C, high deductible plans require referrals for all specialists? Or D, HMOs never require members to choose a primary care physician? The correct answer is A. High deductible plans usually have lower monthly premiums but higher upfront costs. A high deductible health plan typically has lower monthly premiums but higher out-of-pocket costs before coverage begins, while HMOs usually have lower deductibles and require network provider use. Medical expense coverage terminology. What is the primary purpose of a deductible in a health insurance policy? Is it A, to require the insured to pay a set amount before coverage begins? B, to increase the total coverage amount? C, to eliminate the need for coinsurance? Or D, to guarantee all medical expenses are covered? The correct answer is A, to require the insured to pay a set amount before coverage begins. A deductible is the amount the insured must pay out of pocket before the insurance company begins to pay for covered medical expenses. It helps reduce minor claims and controls premium costs. Which of the following is not typically considered a covered medical expense under a standard health insurance policy? Is it A, hospital room and board? B, physician office visits? C, elective cosmetic surgery? Or D, prescription medications? The correct answer is C, elective cosmetic surgery. Why this is tricky? Some options may sound like common medical expenses, but not all are usually covered. Cosmetic procedures are generally excluded unless medically necessary, while the others are standard covered expenses. Maria visits an in-network hospital for surgery and must pay a percentage of the total bill after her deductible is met. What is this percentage payment called? Is it A, copayment? B, coinsurance? C, premium? Or D, out-of-pocket maximum? The correct answer is B, coinsurance. The percentage Maria pays after meeting her deductible is called coinsurance, which is a common cost-sharing feature in health insurance policies.
Did you get a different answer? Or maybe you have a question about the exam in general? Drop it in the comments below. We read and answer them personally.
Disability income insurance terminology. Which term describes the period an insured must wait after becoming disabled before disability income benefits begin? Is it A, elimination period? B, benefit period? C, probationary period? Or D, grace period? The correct answer is A, elimination period. The elimination period is the waiting time after a disability occurs before benefits are paid. It is a key feature in disability income insurance policies and helps determine when the insured will start receiving payments. Which of the following best describes the benefit period in a disability income insurance policy? Is it A, the time allowed to pay overdue premiums? B, the maximum length of time benefits are payable for a covered disability? The waiting period before benefits begin? Or D, the period during which the policy cannot be canceled by the insurer? The correct answer is B, the maximum length of time benefits are payable for a covered disability. Why this is tricky? The benefit period is often confused with the elimination period. The benefit period is the maximum time benefits are paid for a single disability, not the time you must wait before benefits start or the time to pay premiums. Maria purchased a disability income policy with a 90-day elimination period and a 2-year benefit period. If she becomes disabled and cannot work, when will her benefits start and how long could they last? Is it A, benefits start immediately and last for 2 years? B. Benefits start after 2 years and last for 90 days. C. Benefits start after 90 days and could last up to 2 years. Or D. Benefits start after 90 days and last for 90 days. The correct answer is C. Benefits start after 90 days and could last up to 2 years. Maria's benefits will start after the 90-day elimination period and could continue for up to 2 years, which is the benefit period specified in her policy. Both terms are essential in determining her coverage timeline. Long-term care insurance terminology. Which term describes the period an individual must wait after becoming eligible for long-term care benefits before payments begin? Is it A. Benefit period, B. Elimination period, C. Guaranteed renewability, or D. Inflation protection? The correct answer is B. Elimination period. The elimination period is the waiting time after a policyholder qualifies for long-term care benefits, but before the insurer starts paying. This term is fundamental in long-term care insurance and affects when benefits are accessible. Which of the following statements about long-term care insurance is not accurate? Is it A. Long-term care insurance can cover care in a nursing home? B. Policies may offer coverage for home health care services. C. Benefits are always paid directly to the care provider. Or D. Some policies include coverage for adult daycare. The correct answer is C. Benefits are always paid directly to the care provider. Why this can be tricky? The question asks for the statement that is not accurate. Many test takers may overlook the negative phrasing and select a true statement. Only the third option is false regarding how benefits are paid. Health policy provisions. Mandatory and optional policy provisions terminology. Which provision is mandatory in individual health insurance policies and requires the insurer to pay claims immediately upon receipt of proof of loss? Is it A. Time of payment of claims, B. Change of occupation, C. Misstatement of age, or D. The correct answer is A. Time of payment of claims. The time of payment of claims provision is mandatory and ensures that insurers pay claims promptly after receiving proof of loss, protecting policyholders from unnecessary delays. Which of the following is not a mandatory policy provision under standard health insurance contracts? Is it A. Notice of claim, B. Proof of loss, or D. Time limit on certain defenses? The correct answer is C. Change of occupation. Why this can be tricky? Change of occupation sounds important, but it is actually optional, while the others are required by law in standard policies. Maria files a claim for a covered illness, but her insurer delays payment for several months. Which mandatory provision is intended to protect her in this situation? Is it A. Physical examination and autopsy, B. Time of payment of claims, C. Change of beneficiary, or D. Legal actions? The correct answer is B. Time of payment of claims. The time of payment of claims provision requires insurers to pay claims promptly after proof of loss is submitted, protecting policyholders like Maria from unreasonable delays. A policyholder changes jobs to a more hazardous occupation without notifying the insurer and later files a claim. Which optional provision could affect the claim amount? Is it A. Entire contract, B. Grace period, C. Reinstatement, or D. Change of occupation? The correct answer is D. Change of occupation. The change of occupation provision is optional and allows the insurer to adjust benefits or premiums if the policyholder changes to a more hazardous job without notice. Cost-sharing elements terminology. Which cost-sharing element requires the insured to pay a fixed amount for each covered service, such as a doctor's visit? Is it A, copayment, B, deductible, C, coinsurance, or D, premium? The correct answer is A, copayment. A copayment is a fixed dollar amount the insured pays for specific services, such as office visits or prescriptions, regardless of the total cost of the service. Which of the following statements about coinsurance is not correct? Is it A, coinsurance is usually expressed as a percentage, B, coinsurance applies after the deductible is met, C, coinsurance is a fixed dollar amount paid for each service, or D, coinsurance requires the insured to pay part of the covered expenses? The correct answer is C. Coinsurance is a fixed dollar amount paid for each service. Why this can be tricky? The word not requires you to identify the false statement. Coinsurance is a percentage of costs shared after the deductible, not a fixed dollar amount or a one-time payment. Maria visits her doctor and pays a set fee at the time of service, while her insurance covers the rest. What cost-sharing element is Maria paying in this situation? Is it A, deductible, B, copayment, C, coinsurance, or D, out-of-pocket maximum? The correct answer is B, copayment. Maria is paying a copayment, which is a fixed amount due at the time of service, regardless of the total cost of the visit. Renewability and cancellation provisions terminology. Which type of health insurance policy guarantees the insurer cannot cancel coverage except for non-payment of premium? Is it A, optionally renewable, B, non-cancelable, conditionally renewable, or D, guaranteed renewable? The correct answer is B, non-cancelable. A non-cancelable policy guarantees the insurer cannot cancel coverage or increase premiums as long as premiums are paid on time. This provision offers the highest level of renewability protection for the insured. Which statement about guaranteed renewable health insurance policies is not correct? Is it A, the insurer must renew the policy if premiums are paid, B, coverage cannot be canceled except for non-payment of premium, C, premiums cannot be increased for any reason, or D, the insured has the right to continue coverage until a specified age? The correct answer is C. Premiums cannot be increased for any reason. Why this can be tricky? Guaranteed renewable policies must be renewed by the insurer if premiums are paid, but the insurer can raise premiums by class. The incorrect statement is that premiums cannot be increased, which is a common misconception. California Insurance Regulations. California Insurance Code definitions. Which of the following best defines an insurance agent under the California Insurance Code? Is it A, a person authorized by and on behalf of an insurer to transact insurance, B, a person who only provides insurance advice for a fee, C, a person who adjusts claims for an insurer, or D, a person who represents only policyholders in insurance matters? The correct answer is an insurance agent is defined by the California Insurance Code as a person authorized by and on behalf of an insurer to transact insurance. This definition is foundational for understanding licensing and regulatory requirements in California. According to the California Insurance Code, which of the following is not considered a type of insurance? Is it A, fire insurance, B, disability insurance, C, banking insurance, or D, life insurance? The correct answer is C, banking insurance. Why this is tricky? The question uses a negative and includes plausible but incorrect options. Banking insurance is not a recognized type under the California Insurance Code, while fire, disability, and life insurance are all defined types. Maria, a licensed California insurance producer, helps a client select a policy and collects the initial premium on behalf of the insurer. Under the California Insurance Code, what role is Maria performing in this transaction? Is it A, broker, B, adjuster, C, consultant, or D, agent? The correct answer is D, agent. Maria is acting as an insurance agent because she is authorized to transact insurance and collect premiums on behalf of the insurer, which fits the legal definition in California. Agent licensing and conduct terminology. Which of the following best describes the term fiduciary responsibility as it applies to a licensed insurance agent in California? Is it A, the obligation to advertise only approved products? B, the duty to act in the best interests of clients and properly handle their funds? C, the requirement to maintain a physical office in California? Or D, the ability to represent more than one insurer at a time? The correct answer is B, the duty to act in the best interests of clients and properly handle their funds. Fiduciary responsibility means that an insurance agent must act in the best interests of their clients, handling premiums and client funds with honesty and care, as required by California insurance regulations. Maria, a newly licensed California insurance agent, receives a client's premium payment in cash and places it in her personal bank account for safekeeping until she can deliver it to the insurer. What regulatory issue does this situation illustrate? Is it A, failure to disclose all policy exclusions? B, misrepresentation of policy terms? C, commingling of client funds with personal funds? Or D, unauthorized sale of insurance products? The correct answer is C, commingling of client funds with personal funds. California regulations prohibit agents from commingling client funds with personal funds. Maria's action violates the rule requiring agents to keep client premiums in a separate trust account or promptly remit them to the insurer. Unfair trade practices terminology. Which of the following best describes the term rebating as it applies to unfair trade practices under California insurance regulations? Is it A, offering part of an agent's commission to a client as an incentive to buy insurance? B, charging higher premiums to clients based on their occupation? Failing to disclose policy exclusions to the applicant? Or D, refusing to renew a policy without cause? The correct answer is A, offering part of an agent's commission to a client as an incentive to buy insurance. Rebating refers to the illegal practice of offering a portion of the agent's commission or anything of value as an inducement to purchase insurance, which is prohibited under California law to ensure fair competition. An insurance agent in California tells a prospective client that she will receive a free vacation if she buys a policy from him. According to unfair trade practices terminology, what is this agent engaging in? Is it A, twisting, B, churning, C, illegal inducement, or D, defamation? The correct answer is C, illegal inducement. Offering a free vacation as an inducement to purchase insurance is considered an illegal inducement, which is a form of unfair trade practice under California insurance regulations. Privacy and confidentiality rules terminology. Which term describes the legal obligation of California insurance licensees to protect a client's personal information from unauthorized disclosure? Is it A, transparency, B, confidentiality, C, disclosure, or D, indemnification? The correct answer is B, confidentiality. California insurance regulations require licensees to maintain confidentiality of clients' personal information. The legal obligation to protect this information from unauthorized disclosure is referred to as the duty of confidentiality. Which of the following is not considered personally identifiable information under California insurance privacy regulations? Is it A, Social Security number, B, home address, C, policy number, or D, full name? The correct answer is C, policy number. Why this can be tricky. Some information, like a policy number, may seem personal but is not classified as personally identifiable information under California law. Name, address, and Social Security number are all considered personally identifiable. Ethics and consumer protection. Fiduciary responsibilities. Terminology. Which term describes the legal obligation of a real estate licensee to act in the best interests of their client at all times? Is it A, disclosure, B, fiduciary duty, C, dual agency, or D, material fact? The correct answer is B, fiduciary duty. A fiduciary duty is the legal obligation requiring a real estate licensee to act in the best interests of their client, prioritizing the client's needs above their own. This is a core concept in real estate ethics and consumer protection. Maria, a licensed real estate agent, receives confidential financial information from her seller client. What fiduciary responsibility requires her to keep this information private, even after the transaction closes? Is it A, loyalty, B, obedience, confidentiality, or D, reasonable care and skill? The correct answer is C, confidentiality. The duty of confidentiality requires agents to keep client information private during and after the transaction. This protects the client's interests and is a fundamental fiduciary responsibility in real estate practice. Replacement and disclosure requirements terminology. Which document must be provided to a consumer when replacing an existing life insurance policy to ensure full disclosure of the replacement process? Is it A, policy summary, B, replacement notice, C, buyer's guide, or D, application form? The correct answer is B, replacement notice. The replacement notice is a required disclosure that informs the consumer about the implications of replacing an existing policy. It helps ensure the consumer is aware of potential consequences and alternatives before proceeding. Maria, an insurance agent, is helping a client replace an old life insurance policy with a new one and must comply with disclosure requirements. What must Maria do before submitting the application for the new policy? Is it A, collect the premium payment first, B, submit the old policy for cancellation first, C, provide a replacement notice to the client, or D, deliver the new policy before any disclosure? The correct answer is C, provide a replacement notice to the client. Maria must provide the client with a replacement notice before submitting the application. This ensures the client is informed about the consequences and alternatives of replacing their policy, as required by consumer protection regulations. Policy illustrations and advertising terminology. Which of the following best describes the purpose of a policy illustration in insurance advertising? Is it A, to guarantee future policy values, B, to demonstrate possible policy performance using projections and assumptions, C, to replace the actual insurance contract, or D, to provide legal advice about insurance products? The correct answer is B, to demonstrate possible policy performance using projections and assumptions. A policy illustration is designed to show how a policy might perform over time, including both guaranteed and non-guaranteed elements, to help consumers make informed decisions.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit birdsey.ai to start your free trial of Birdsey, your AI-powered study partner.